Good morning, everyone. This is Dave Kanicki, editor and publisher of Ag Equipment Intelligence. Welcome to our latest webinar on how to increase the value and marketability of your business before an eventual sale. In this webinar, we'll discuss the current conditions in the agricultural equipment capital markets and what private business owners can do to drive the value of their businesses before an eventual sale. As you all know, mergers and acquisitions among farm equipment dealers as well as equipment manufacturers have become almost everyday news in the past 5 to 10 years. In the first 2 months of 2019, we've reported on 11 dealer mergers and/or acquisitions, 4 manufacturer acquisitions, and even the merger of 2 major equipment dealer associations. This was the impetus for the publishing of our annual Big Dealer Report. The first was that tracks mergers and acquisitions in the dealer segment of the industry was issued in 2011. The reasons why owners want to buy or sell businesses are varied. For example, Ag Equipment Intelligence conducted a survey of dealers in early February 2019, where we asked about the age of current dealership owners and principals. The results showed that nearly half of this group are 61 years old or older. Only 18% were under 50 years old. In that same survey, we asked dealers if they would consider selling their dealership in the next 3 to 5 years. Of the group responding to this survey, 41% said yes, they would or are considering selling their dealerships. 35% said no, they aren't considering it, and 24% responded maybe. I suspect we would observe the same types of response if we poll short-line equipment manufacturers. Today's presenter is Eric Bosveld, Director of Food and Agribusiness at SDR Ventures. Eric and I have been discussing joint projects for the past year or more. This led to the creation of the Agricultural Equipment Capital Markets Report, a quarterly publication that is sent to Ag Equipment Intelligence subscribers. During today's webinar, Eric will discuss the current conditions in the agricultural equipment capital markets and what private business owners can do to drive the value of their business before an eventual sale. Valuations of similar businesses can vary for a wide range of reasons, some which can be influenced by good planning and focused attention before going to market. This webinar will walk participants through the key actions that management can take to stimulate broader buyer interest and ultimately more competition between buyers. Before Eric gets started with his presentation, I have a couple of housekeeping items. On your screen, there is a control panel with a Q&A icon. You can submit questions here at any time during the presentation. Time permitting, we will look to answer as many questions as possible following the presentation. If, for any reason, you lose your internet connection, or if our connection should happen to fail at some point, and it looks like the webinar has been interrupted, just go back to the email you received earlier telling you how to join the webinar, and you can re-enter the webinar in that way. Okay, we're ready to get started. Thanks again for joining us. Okay, Eric, it's all yours.
Well, thanks, Dave. Certainly really appreciate the opportunity to talk to your AEI subscribers and the other guests that have joined the webinar. As Dave mentioned, we've worked together on putting together a quarterly report, and I certainly encourage you to browse through that at your leisure to kind of look at some of the data that we compile on a regular basis. So the agenda for today's webinar is really to cover off on 3 main topics. We want to review the current market conditions and the impact that those market conditions can have on the value of the business should you decide to sell. We want to talk about some of the drivers that will impact the way the market reacts to your business, and a few things that you can maybe do to increase the value and marketability of your business. And then finally, we want to talk about some of the key factors that you should consider on how to sell your business and the impact that they can have on the value on your selling price. And as Dave mentioned, we'll make sure we have some time at the end to answer any questions that you have. So to start off with, I want to give you a little bit of background about SDR Ventures and myself. SDR Ventures is a US-based lower middle market investment bank based out of Denver, Colorado. They basically do three things. They help clients sell a business, help clients buy a business, or they help clients raise capital, typically later stage growth capital for established businesses, not a whole lot of really early stage stuff. Probably about 75% of their engagements are in the sell representation side. They are involved in all kinds of different industries, and I lead their food and agribusiness M&A advisory practice for Canada and the US. I'm also an independent consultant, and I assist my clients in some M&A advisory work, typically in deals that are not necessarily well suited for SDR's process. Typically, those might be businesses that are a little bit too small. I do some consulting work with private equity groups, assisting them in doing due diligence on some buy-side engagements. And I do some strategic consulting, working with clients, helping them to get prepared for an eventual sale and reviewing their business operations and hopefully adding some value to the business once they are ready to go to the market. Outlined on this slide as well as a summary of some of the select transactions that we collectively have been involved in businesses in the seed space, the produce sector, irrigation equipment, specialty fertilizer, specialty chemicals, growing medium, component manufacturing and distribution. So we've touched on a number of different areas in the agribusiness and food sector. I've also worked quite extensively on about half a dozen projects with private equity firms that were looking at acquiring businesses in the ag equipment manufacturing space. If you look at the general area that we focus in on, we're involved in businesses all the way up and down the supply chain. We don't do a whole lot at the very end, at the point of sale, probably a little bit more upstream stuff. And of course, companies that process and handle ingredients and so on are also a focus area of ours. If you look at what the type of clients SDR typically takes, we usually look at companies with at least $2 million of EBITDA, so that's earnings before interest, tax, depreciation, and amortization, and with at least $10 million in sales. We do some engagements that are larger businesses than 100 million in sales, but typically we start running into the Goldman Sachs and the larger investment banks in those types of deals. So our sweet spot is at 10 to $100 million in revenue. And the other key factor that we consider in looking at our engagements is whether or not a business is conducive to a competitive auction. In other words, are we going to get multiple potential buyers that are going to compete with each other to hopefully drive the best value terms and value and terms for our clients? So the way to look at what the ultimate selling price of your business will be is from forces that are coming in three different directions. One is obviously the market conditions. What are the prevailing conditions? So you're answering the question about when to go to the market there. The second is obviously what it is that you're selling, and that's of course the most important factor. And the third is how do you sell that business? One of the things that I think it's really important to think about for business owners is that the transition really should be thought of as a process rather than an event. If you think of it as in a process, you are going to probably be better prepared. You may need to start preparing for the sale maybe 3 to 5 years in advance, or you may end up risking really being disappointed by the way the market reacts to your business. We often will see that business owners grossly overestimate the value of the business and how the market will respond, and grossly underestimate what it is that it actually takes to sell the business. So those are the three factors that we really want to address. When you look at what you're selling, the business, I think we like to think about it as two different types of drivers, both interrelated. One is the actual value drivers, what means that the things that drive the value or the multiple of the business and the actual selling price. And then interrelated to that are marketability drivers. Things that may have an impact on value, but they may not as well. They just may mean that you open up the more opportunities, talk to a larger set of buyers, or may make the difference about getting a deal closed or not. So let's start off with a discussion around the win. What's going on in the market today, what has been happening, and how is that going to impact your decision on when you should go to market. We've been hearing from a number of different sources that the market has kind of softened a little bit in the last half of 2018, and we certainly have seen a little bit of that being backed up by some of the data that we collect. This is the overall M&A activity in the US. We don't, unfortunately, have the same equivalent data in Canada, but my feeling is that generally this is applicable to both markets. So your EBITDA multiple is the typical metric that people use to look at comparisons between what one business traded for versus another. So the EBITDA multiple is your enterprise value, which is all the equity, including retained earnings, minority shareholders, preferred shares, plus the debt on the company divided by the EBITDA. And that's typically a way that M&A professionals can look at relative deal valuations. If you look at the average multiples over the last few years, and we've gone back here, in this case, back to 2011, we've seen a general strengthening, particularly from about the 2014 to the 2017 period, and then a slight pullback in 2018 in most deal size categories. So for example, in the $10 to $25 million enterprise value, the average multiple dropped from 6.2 times EBITDA in 2017 to 5.8 times EBITDA in 2018. In the $25 to $50 million deal size category, it dropped from 6.6 to 6.2. This amounts to about a 6% drop in value. In the larger deal size, from greater than $50 million in enterprise value, there was less of a drop. In fact, there was actually a little bit of an increase, slight increase in the $50 to $100 million value, and a slight decrease in the $200 to $250 million deal size category. The one take home here, and this is something that a lot of people don't completely understand, is that you tend to get higher average multiples for bigger companies. And so you need to take in the deal size in consideration when you're doing your comparables. Smaller companies actually tend to be a little more risky for investors. They often rely more on a core team of people, particularly the management team. They tend to be a little bit costlier to finance, and therefore an investor needs to write a bigger equity check and can't use as much debt. And that means that they generally tend to trade at a bit of a discount compared to their larger counterparts. Now, looking at the public markets, we decided to go back, in this case, back to the end of 2013. The ag equipment market has more or less ended up the same as the same place as the S&P 500 since the end of 2018. Since the end of 2013. And at the end of 2017, it substantially outperformed the broader market. It's a little strange considering, commodity prices really dropped pretty dramatically in 2014 and into 2015. But in spite of that, the index that we look at performed quite well, particularly from about 2016 on. But if you look at the actual share price change from the end of 2017 to the end of 2018, it's been brutal, and I think that's been well recognized in the market. We segment the public companies into three different categories: the large cap manufacturers, which includes companies like John Deere and Case New Holland; mid-size manufacturers, which would include companies like Valmont, Lindsay, Raven; and then the agricultural equipment dealers, which I'm only aware of three that are publicly traded in the North American markets: Service, Titan Machinery, and Rocky Mountain. There might be more, but if you look, what's interesting here is that all three of those segments have kind of converged in around that 7.6 times EBITDA multiple. Now, I have to qualify that a little bit. Typically, most people don't look at public companies on an EBITDA multiple basis, but that's typically what we use to compare how a private company may trade in the marketplace. And we use what we call as a 30% DLOM, or a discount for lack of marketability. Obviously, if you're a shareholder in a public company and you decide to sell, well, you just tell your broker or go online and put the sell order, and not long after, you got the money in your account. And obviously, selling a private company is a lot more complex and just can't happen that way. So there is a discount, whether it's 30% or not. That's the one we tend to use, but it does make the multiples a little bit more comparable. We also track in our capital markets report the transactions that we can find good data on in terms of deal multiples and the deal size. Since beginning of 2013, the average EBITDA multiple has been 9.1 times EBITDA and 1.2 times revenue. I'm sure there's deals that we've missed, that have either been announced or even obviously unannounced deals won't be reflected in this, but typically they're not published in terms of the deal metrics as well. The other thing to keep in mind is that we're probably picking up deals that are a little bit broader than just the ag equipment marketplace here. Some of these businesses have overlap into construction, food production equipment, landscaping, forestry, and so on. So it's not a pure ag equipment metric, but it does give you some indication of of what the market has been doing over the last 5 years or so. I think most listeners would agree that the ag equipment market has struggled since about the 2014-15 period. After coming off some very, very strong years, there's been a lot of inventory that needed to be cleared out of the channel, and customers were and have not been making a lot of money. I think this is generally the case in both Canada and the US. Maybe the Canadian market has been offset to some degree, by a lower Canadian dollar, help offset some of those lower commodity prices. But certainly 9.1 and 1.2 are strong multiples. But you also have to reflect that on the deal size as well. And as I showed earlier, smaller deals typically are not trading at the same multiples as the larger deals. And quite frankly, a lot of the smaller deals, the actual transaction multiples are kept confidential. So a lot of these times it's because a public company needs to disclose what the deal metrics were for their shareholders. And those are some of the transactions that we're picking up here. So next, let's move on to the business value and marketability drivers, or the what you are selling and how that impacts the value. There's a lot of this stuff that's common sense, and so we don't need to go in through a whole lot of details. Obviously, if you have a bigger business that's more profitable, it's worth more. But some of the things that maybe owners don't always think about are some of the thresholds that are kind of important. We see things like businesses with $2 to $3 million of EBITDA, at least at the minimum, trade at a little bit better multiple than ones that are less. And that has to do with the cost of financing smaller deals, and the reliance on a lot of those smaller companies on a core group of people and the risk associated with that. We also like to see the EBITDA margins greater than equal or to 10%. And that's important for manufacturers to be above that. Not all of them are. That's maybe sometimes a bit of a stretch for dealers, but again, that threshold of about 10% EBITDA margin tends to drive more buyer interest and therefore better multiples. Another one that's important, related directly to the ag equipment market, is the absorption rate. Obviously, if you can have a higher absorption rate, that generates a stronger interest, and your business should be worth more. A lot of the other stuff is pretty obvious. Obviously, you want a faster growing company and potential growth potential. How differentiated are your products and services in the market? Are there things that you're doing in your market that are unique? Are you addressing a large market with growth potential? All of these types of factors are really important. The quality of your assets, how much reliance you have on your suppliers. Obviously, this is a big factor for dealerships that are tied, or John Deere or Case New Holland or AGCO. Obviously, you have a high reliance on a limited number of suppliers, and that can impact the number of potential buyers, and that also can impact the value. We'll spend a little more time on the quality of the revenue. Of course, the management team's important. How cyclical is your industry, and so on. So I want to talk about, I think, 4 different things that you can do today before you put your business on the market that may have some impact on the value you receive, and at the very least, how marketable your business will be. The first one is making the business less reliant on you. Really, the take home is less doing and more coaching, and building that team around you from all of the major functional areas of the business. Working 100 hours a week and making sure that everything is done exactly the way you want it done may keep your business operating pretty efficiently, but doesn't do anything to add the value of your business. A new buyer knows that in all likelihood, you're not going to spend those 100 hours a week and do everything yourself, even if you roll some equity. So it's really important to start well in advance of putting the business in market on the market, so that you're well on your way here. If you're a larger company and you got 100 million in revenue already today, then you probably did this a long time ago. You can't be involved in every decision that's being made by the business. You've had to build a good team around you. So businesses with a strong management bench and a culture that embraces personal and professional development are much more marketable and often worth more to a buyer. So what are some of the obvious benefits? It reduces the risk. It allows a new buyer to bring in a fresh perspective with some talented support behind them. Obviously, it can drive value for the business if the owner has more time to work on the business rather than in the business, whether that's new product development or developing new markets. And of course, it's a big motivator for employees if they have an opportunity to increase their responsibility and have a bigger role with how the business is operating. So some of the things that you should be looking at doing, looking at your recruiting efforts, how are you attracting new talent? What's your onboarding program like? Are you incorporating personal development goals into your HR practices? Are you looking at cross-training opportunities between functions so that you can build talent across the management team? Are your processes well documented so you can have people back up each other? and then learn other different functions of the business. One way to test yourself a little bit on whether or not the business is relying heavily on you is to start taking a little bit of time off and getting away from the business, and then coming back in and seeing how things kind of function, in your absence. Start shaking things up a little bit, seeing who adapts well to the situation, and who is the resistors out there, because that's going to be important through a transition. The second action that you can take to increase the value or the marketability of your business is to formalize your strategic business planning process. A lot of people obviously do this, but it's amazing to me how many businesses in the smaller deal space or the lower middle market don't do a really good job of formally putting together a comprehensive business plan and then executing that plan. So the goal here really is to plan the work and then to work the plan. Makes the business a lot easier to sell, and obviously it can impact the value if you're effective at this and you're much more strategic in the way you're operating your business. So I don't think there's a lot of issues on how you compile your plan, how you put it together, what techniques you use. The key things are that it's reviewed regularly, it's well executed, and that you include some type of measurement of the key strategic initiatives that you plan to take. It's really important that the execution and the measuring and review are kind of done on a continuing basis. I personally like hearing it when I hear about businesses that regularly incorporate an off-site 2-day strategic planning workshop kind of on an annual basis or more or less regular basis. Obviously this helps build camaraderie, gets everybody on board and the management team in terms of the direction and the priorities that you're going to have. But it certainly can drive performance and can help identify major issues, before they become major problems. Obviously, the benefits are for the buyer is that they're going to understand your business better. If they don't understand your business and where the market potential and the growth potential is, they're not going to step up and pay you for probably what it's worth. So there's real good reasons for you to be able to articulate that through a business plan to any potential buyers. This one is a little bit tougher, improving your revenue quality, but it's really, really important. And the earlier you can start focused on this and keep it top of mind, the better. So businesses that are very innovative and are constantly introducing new products and new services and generate a high percentage of their revenue coming from those newer products and newer services tend to trade at higher multiples. And that just is a measurement of how innovative you are in your marketplace. There's obviously risks associated with a buyer. There's a lot of customer concentration or a lot of product line concentration. So anything that you can do to diversify your revenue streams from a broader base of customers or a broader base of products lowers the risk for any potential buyer, and therefore means they should be able to pay at a higher multiple. And of course, anywhere where you can generate recurring revenue and make that a bigger part of your overall business impacts the value of the business as well. So I'm thinking here, things like precision ag services could be something that's really effective in generating recurring revenue if you've got regular clients that are utilizing your services. Parts sales, obviously, that could be a really important recurring revenue stream as well. Your service revenue, those types of things, all impacts the value of your business. The last area that I want to focus in on that can really impact the value of your business is doing some sellers pre-sale due diligence is the way I like to refer to it. It's kind of like getting your house in order. It's kind of like if you were to sell your house, it's time to maybe renovate the bathroom and do some paint and clean up the backyard. These are the types of things that you do equivalently in your business to kind of, I'll say, polish the apple and make it more presentable. So there's a lot of those physical things, but that are obvious. But really, the key thing that you're trying to do in getting your house in order is trying to figure out what are the issues that a buyer might run into when they're conducting their due diligence that may either be a deal breaker or may push them to offer a lower multiple. So all of these things are, there's just a ton of them depending on your business, but, questions I have quickly are, are your policies are all updated and in place? Have you got all your contracts up to date? Do you know where all your third-party consents are required? Obviously, if you're a dealership, you're a John Deere dealership, you got to understand the implications of putting your business up for sale in terms of your dealership agreement with your suppliers. Have you been conducting audits? Typically, you'd like to have an audited statement if possible, or at least a review engagement. What's the quality of your financial reporting? Have you removed all of any owner's benefits or adjustments? It's amazing what we'll see. We'll see everything from the kids' country club membership to the boat, to the cottage, to all kinds of stuff that get put into business financial statements. You want to clean all of that up. And obviously you can adjust for that when you're presenting the statements, but it's much better to have that all outside of the business prior, well before going to the market. So your training program's all up to date. Have you got old inventory or receivables that need to be really closely looked at, or the processes in place that you have for managing, inventory write-downs and so on? Is that all in place? Are there any redundant assets that should be sold? One of the things in this part of the process is considering separating out your real estate from the operating business. If you haven't done that already, it certainly means more flexibility for buyers. Some buyers may just want to buy the operating business and would prefer to lease the real estate on a long-term basis from the legacy owners. So a sale leaseback and prior to going to market sometimes may make sense if it doesn't cost you a lot. Doing environmental reviews like a phase 1 to identify whether there's issues. There's a ton of these things there. And obviously, this allows you an opportunity to correct issues well before going into market, reduces the obstacles that you may find when you're in transaction negotiations that help ensure a close, keeps you more parties at the table. And if you get in late stage negotiations and some of the stuff starts to show up, the tendency is buyers will start to look at retrading, and this limits the amount of leverage that they'll have to do that. So the last section, as we finish up here, is the actual how, or the selling process. It certainly can have an impact of the value that you get from potential buyers. The biggest decision that you first need to make, or the most significant decision, is whether to hire an outside advisor like SDR Ventures and to help run a competitive process, or you want to do it yourself. There's pluses and minuses, like everything, for both approaches. If you decide that you want to hire an outside advisor to help run a competitive process, the next part of that decision is, do you hire an investment bank or a broker? A broker tends to specialize in businesses that are sold locally. They're often less than $5 million in sales, so they go into the really the small business sector. And they often sell more generic type businesses that can be listed through their network. So examples, of businesses that typically will use brokers are restaurants or wineries, retail stores, gas stations, those types of businesses. There's often a significant real estate component. So a lot of these brokers will also be real estate brokers. And like I said, it's more of a listing type service, but it does create potentially some competition. An investment bank like SDR is more of a business that is going to go out and actively market your business to a set of potential buyers. So that's going to include both typically just financial buyers or investors, wealthy individuals, family offices, private equity firms, as well as industry players or strategics. Typically, an engagement investment bank is going to invest thousands of hours of professional hours in engagement to ensure a successful outcome. So, like I said, doing every decision, there's pros and cons. Obviously, if you decide to do it yourself, you're going to save a lot on fees. And hiring an investment bank is not inexpensive at all. Either way, even if you decide to do it yourself, you'll still need likely outside legal and tax advice. And we always recommend that you don't necessarily just go to, your corporate lawyer that you've used for everything, or your outside accountant that you've used personally. You really want to find somebody that's specialized in M&A transactions. The investment bank's role was not really to provide you with tax advice or legal advice, although, if we're good, we're pretty well versed in those matters. But the reality is what we're really good at is running a competitive process and focus on generating healthy competition between buyers and hopefully be a solution provider as you negotiate through the transaction in concert with your other outside advisors. There's two different real things to think about in terms of the relative role of an investment bank versus the relative role of your outside advisors like tax and legal. Tax and legal typically are going to charge you hourly fees, and so there is potential motivations to have the deal string on, and they're going to look at the thing from every angle, and not that they should, but the motivation is potentially to have a large number of billable hours. An investment bank is weighted very heavily for their incentives on the transaction close, where the majority of the fees are usually collected. And so you want to make sure you don't have an investment bank that's a deal advocate. You want to make sure they're a client advocate. And you want to make sure your outside advisors in tax and legal are not a client, are not a client advocate, but they're a deal advocate. In other words, they have to be motivated to try to get a successful transaction, because obviously you didn't jump into this scenario with the end goal of not completing a deal. Obviously you wanted to complete a deal. So that's a good way to think about, your outside advisors, in my opinion. Negotiating a letter of intent and a definitive agreement is a really tricky process. And it's really a process of give and take. And, we believe that if you give something, you should get something. And we try to work through that. Sometimes what you give and what you get is not going to be balanced. If it goes on forever like that, you'll never get a deal done. So there needs to be compromise. But it is really tricky, and the viewpoint that you're going to get from all your outside advisors is actually going to be really helpful for you. So, like I mentioned, one of the biggest reasons people decide to do it themselves is the cost savings. You can save some fees, there's no doubt. You are going to be giving up a few things, and you're going to get a few things. One is you're going to obviously get a chance to talk to buyers directly, right from the early stages on. You can maybe sell your business a little bit quicker because in all likelihood, you're not going out to as many potential buyers. And, there's cases when your business is really just not in a situation where a competitive process is really well suited. There may be really just a single potential buyer. And so you need to negotiate the best deal that you can with that particular buyer. When your business is more conducive to a broader process, it becomes a lot more complicated. It takes a lot more time. And so if you hire an investment bank, obviously that allows you to focus continuing to run the business as your investment bank does all of the preliminary work and narrowing down the field to the later stage negotiations. And this healthy competition obviously could drive some value, but and it allows you to actually stay focused on running the business. The biggest reason deals don't close is because people get distracted and the performance of the business drops off, and then all of a sudden, you don't have the earnings that the buyer was expecting, and they typically will go out and what we call in the trade retrade, and you end up with either a failed deal and two disappointed parties, or you sold it at a discount from the initial bids. We break the deals up into three broad categories. The negotiated sale on one end and a broad auction on the other. There's pros and cons. And again, if you send me an email, I'll send you the whole PowerPoint. We can go through the pros and cons of these in a little more detail. But we generally think a negotiated sale still requires maybe 6 to 8 potential buyers. You have a lot more flexibility in how you run the process. They tend to be, if closing speed is an important factor, you can do a deal quicker. The broad auction is definitely more complicated. It's a little more process driven, takes a longer period of time, but the whole goal of a broad auction is you leave no stone unturned and you hopefully find the best buyer at the best value. One of the key factors that we look at before we get involved in any engagement is making sure that we're on the same page as our client in terms of evaluation expectations. So we do a pretty extensive pre-engagement preliminary evaluation. We build out the models, we look at comparables, we'll look at what the public companies' comparables are, as well as what M&A transactions we can find for similar kind of businesses. And we'll come up with a range of valuation. And if there's a huge difference between what we think a business is likely to trade for and our client thinks is the minimum they would accept, then we typically are a pass. I've got one scenario right now where we've come up with a valuation of around $12 to $14 million. The owner has said, he thinks the business is worth 18 to 20. There's too big of a gap. Now, that's not to say that if we do engage with them that we wouldn't shoot for the 18 to 20, but we are in a situation where we need to close deals and can't be wasting time, trying to test the market on things. That's not to say, like I said, you won't get it, and you don't shoot for it. It's important to have some basis in reality. Our process typically will be development of the marketing material. You've all probably seen these before. It's typically a teaser as well as the confidential information memorandum. They get sent out to buyers after they've signed an NDA. Key thing is to really, how do you tell the story here and get that initial interest to solicit those initial bids and generate enough interest so that you have multiple bids. Again, I won't go through all of these, but this just outlines the actual in-market process that we typically do. The take-home message here is that we're by our client's side from beginning to end, and our goal is obviously to get that best deal possible that the market will bear with our clients. So that's all the material. So just to summarize, there's three major forces that will impact the value of your business when you decide to sell. The first is the timing, prevailing market conditions of the broader market, including things like interest rates, stock market, the private capital markets, as well as the trends or the conditions in your own specific industry. That will all influence the types of bids that you get. You can track a lot of that type of data in the ag equipment market for AEI subscribers by reviewing our quarterly reports. So that'll help you with some decisions around timing, hopefully. The second and probably the most important factor is the business itself. We've listed a whole bunch of factors that may affect the value and marketability of the business and influence how the market would react to your business if you put it up for sale. Some are obvious, some perhaps a little, hopefully less obvious, and gives you a little bit of food for thought on things that you might want to work on. We also outlined a few specific initiatives like business planning and making yourself not the centerpiece of the business that will help drive value and marketability of the business. And then the final component that we talked about is how do you sell the business should you decide to sell. The biggest decision is whether you do it yourself or hire an outside advisor, and the type of process that you would run. So if you're interested in the PowerPoint, just send me an email at ebosveld, so that's EBOSVELD at SDRventures.com, or give me a call. And that's about all I have. Dave, if you want to start sending me any questions that maybe have come in.
Yeah, thanks, Eric. Yeah, we did receive some questions along the way, so why don't we get started on those? The very first was, can you send us a formula you described to determine value? Could you discuss that a little bit more, Eric?
Yeah, each industry will have certainly some kind of formulas that they use to establish the value of a business. I don't think that we typically look at valuing a business on any type of formula. Like I said, we typically will look at building out the financial models, which tend to be very sensitive to the inputs. So if you're projecting 10% growth per year, it's going to be spit out a completely different multiple or valuation as if you're more realistic to say it's 3% growth. So there are rules of thumb, and I know there's some people in the ag equipment dealership space that have used some formulas. We tend to avoid those, and we look at each business individually and try to come up with a valuation range based on the assumptions that we make for that business.
Okay, remember, you can get in touch with Eric to ask him about those things. So the next question is, what would be considered a normal fee to hire an investment bank?
Yeah, good question. I'll start off with answering that a little indirectly. Typically, it's kind of a combination of some upfront fees as well as a back-end success fee. And so the upfront fees could be a lump sum or it could be a monthly retainer, depending on the situation and how quickly or how extensive the process is expected to go on. And then in some cases that is credited back against the success fee. In more cases it's not. But normal fees are a little bit dependent on the deal size, but they're always going to be six-figure. And if you've got a sizable transaction, let's say $100 million enterprise value, they can be in the seven-figure range as well. For our own personal process, the fees that SDR Ventures charges, there's very few transactions that kind of fit very well for our process, in which that we charge less than, say, $300,000–400,000.
Okay, regarding timing, what are your thoughts on looking forward over the next 5 years?
That's a great question, and I wished I had a really good answer. But I've been in the agribusiness industry for 30 years, so I've seen a few of these cycles. And we certainly are in a scenario where we had a really strong run up, prior to this downturn. And now we've been in my opinion, kind of bumbling along the bottom here for about 4 years, maybe coming into our 5th year. So my internal optimism tells me that at some point we got to see this turn around. Is that next year, later this year, 2 years from now? I wished I knew. Obviously, there's a lot of outside market forces that are really impacting the whole agricultural sector, like trade and the general economy and so on, that are impacting this. But we seem to be along the bottom here for a long time, and we got to start to see some upside here over the next couple of years, I hope.
Yeah, I will add a couple comments to that. As you know, we track the dealer mergers and acquisitions very closely, and we're seeing an uptick in that activity. We're hearing from dealers that some of the manufacturers are pushing very hard for additional consolidation, and we don't expect that to let up in the near future. Particularly if you look at the slides I presented early on. In any case, it looks like it could be very interesting the next few years. Let's go to the next question. Are there certain segments of ag equipment that companies are actively looking to make acquisitions?
So I'll take that question from a couple different angles. So let's start off with the private equity community that may have some interest in ag equipment manufacturers or short ones. Those types of companies are looking actually for a fairly broad base of equipment lines. So they would like to see a business that supplies certain types of equipment into multiple markets, multiple geographies, and across multiple lines. So planters, tillage, all that stuff that is not competing, head to head with the John Deeres of the world. You'd see very few of these private equity companies have any interest in trying to support a buyout of a company that is trying to compete directly in the big ticket items like combines, for example, or tractors and so on. That's a different market completely. So that's the first part. The second part is the industry itself. So one short liner maybe buying out another equipment company, and that I would say is a little bit different in that I obviously are looking for complementary product lines. We certainly have seen some activity around that, and particularly some of the private equity funded short line manufacturers as well. But beyond that, I'm not sure. I could say that tillage equipment companies are of more interest than planter equipment or seed drill or those types of things.
Okay, we've only got time for one or two more questions. This one I thought was very interesting. Someone asked, how does a startup with highly impactful IP and patents do a valuation with year one revenue? Is there such a thing as strategic valuation?
Absolutely, there is. It's just not something that you can really point your finger on and say this. This is how the business is be valued. There's a couple of key criteria. One is any outside investor is going to look at is what is the actual market opportunity? How big is the market? And how is this company actually solving a problem, a big problem, with its technology, and where does it stand in comparison to alternative solutions? So it gets really, really specific. But so there is no rule of thumb, but it's not based on multiples of EBITDA. Obviously, it's not based on multiples of revenue, and it's a much riskier type of investment. And the typical venture capital type investor is going to, first of all, needs to be really convinced that the solution is there and the market is there, but they're going to negotiate some pretty hard and tough terms for a lot of entrepreneurs to accept. The key with those is that to think about those as multiple stages. So you take a little bit of capital to get you through the next stage. You may be at a lower valuation than what's optimal, but you take as little capital as possible to dilute yourself as little as possible, and then make sure you start hitting those milestones. And each time you go back to the market, you've got a track record of where you've delivered to your investors, a greater revenue, greater opportunity, and you should be able to get investors to come in at better and better valuations.
Okay, here's the last question. There were other questions submitted, and as we said, you can contact Eric directly after the webinar. But the final question for the day is, if you have a lot of aged inventory, is it best to sell it at a loss all in 1 year? How will this affect the beta?
Yeah, that's a great question. I hate to see you take a write-off and sell a whole bunch of stuff at a low margin in a given year. Obviously, margin protection is a key factor for any business owner. So I guess it depends a little bit, if it's, how old and how marketable it is. It's certainly not a good idea to have stuff, that's been sitting around for a couple of years and is just deteriorating in terms of quality or competitive technologies that are out there. It does tend to get worse. So I think if you're in a real situation like that, yeah, you're better to bite the bullet and if rather than let it get worse. But obviously you want to balance with that with what the impact is with your business. The other thing I'll say about that too is, if you're planning on selling in 3 years from now, you're probably better off doing that now, and getting a little bit of time between you and when you go to the market, and some improvement in history, and then obviously explain that back to a potential buyer down the road, because most will understand that was an unusual event, and not discount you tremendously because of that.
Okay, this is all the time we have. Today's presentation and audio will be made available on the agequipmentintelligence.com website. If you'd like to go back and review it, it will also be available as a podcast. Watch your email in the Ag Equipment Intelligence newsletter for more information. Again, if you'd like to speak to Eric on a confidential basis, please feel free to email him directly at ebosveld@sdrventures.com. On behalf of Eric Bosveld and the staff of Ag Equipment Intelligence, thanks for joining us today. When you leave the webinar, you will be directed to a short survey. Please feel free to reach out to let us know what you thought of this live event and what other topics you'd like us to cover in future webinars. Thanks again, everyone. Enjoy the rest of your day.